So scarcity versus regular properties is a conversation piece. And again, the more scarce something is, the more valuable it is, the higher the rate of growth you're going to get. And because of the higher rate of growth, you can typically just buy one good property versus two very average properties. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, we're going to dedicate to little Elsie. Yes, one of my favorite workmates has just had a baby. She's had baby Elsie. And what's blown me away is when Elsie's my age, it will be 2075. Wow. Can you imagine? That's some crazy stuff. And of course, Elsie may actually make it to 2100. I don't think I'll make it to 2100, but think about what property values could be in 2100. That's kind of mind blowing that babies today are going to, get into another century. And, what's going to happen to the real estate world? Well, we might have a bit of a discussion about that. But today I wanted to dig into the idea of a really good property versus a couple of average properties, or what that could look like and mean to you, because I know it's difficult. A big part of my job is trying to help people buy real estate in a very difficult environment. And if the new normal is $1 million and you're not spending $1 million, then you're buying in an abnormal place. And of course, when you enter the abnormal, there is different things afoot. And today I wanted to talk about really the idea of building a portfolio with some relatively inexpensive properties versus buying one good one, which today the normal or median price for real estate for a house around Australia in major urban areas is $1 million. So if that's the new normal and we're trying to shop below that, we're shopping in the abnormal. So we're going to dig into that conversation piece. Is there merit to actually buying affordable real estate, or should we just peg our investment around one good one to begin with? So let's do it. Welcome back, regulars. Play the program in double speed. Get your life back. All the episodes I've done are lessons on real estate, so feel free to go back as well if it's your first time tuning in. But I'm back in Sydney. I'm back in the podcast studio. I've been living in Melbourne for the last 3 weeks, which I've really enjoyed. Melbourne's such a cool city, if you ask me. There's good people, good properties, and good pubs, which ticks a lot of boxes in my world. But when it comes to real estate investment, obviously it's about investing in intrinsic value for your future. And quite often people buy on price rather than intrinsic value. And of course, intrinsic value is a combination of what the real estate is today, but equally what it can do for you into the future. Intrinsic value is your future cash flow. Intrinsic value is your future growth, your future upside, and what is built into the deal today. Most people would know I teach my 4X growth plan, which is really an intrinsic value plan. What can you build into the real estate today? What kind of growth are you going to get from its location and its scarcity around what the location can offer? What you're going to get from the market cycle itself and the idea of that growth cycle. And of course, the emotional elements of real estate, which again is really linked to the concept of scarcity. So today we wanted to crack the code of whether it's better to buy sort of two cheapies or just one good one and have a bit of a conversation around that. This conversation tends to come up a lot when we talk to new investors as to how to approach getting into the marketplace. And of course, the general principle of economics is scarcity. Economics is driven by scarcity. Whether you are a country trading with another country, effectively you are trading in scarcity. Australia has a lot of iron ore. There's no shortage of iron ore in Australia. So Australia exports it to countries whereby steel manufacturing is a thing, but a lot of those countries manufacture steel because they're developing economies. They don't have effectively iron ores. So iron ore is scarce in their country, so they're prepared to pay for it. Scarcity drives everything in economics, everything. And of course, it drives real estate. Real estate is driven from this general principle of scarcity. So the scarcer something is, in theory, the higher the rate of growth. And you can see that quite often when you analyze a suburb, you might see particularly a well-to-do, really blue chip suburb that has very limited levels of land to develop. It's very much protected. You can see quite often the house price in those neighborhoods can be a lot. Places like Paddington, Sydney, Middle Park, Melbourne, you know, your homes are $4, $5, $6, $7, $8 million. And then when we go back to their foundation, you know, these homes grew from $30,000 back in the 80s to become $5, $6, $7 million homes. Why? Because of scarcity, the general principle of scarcity. You can't develop in those suburbs. The homes are character. They are architectural. The areas are close to the city. And all of a sudden, Australia grows and you get this kind of, well, that's a pretty scarce resource. I'm going to pay more for it. So never underestimate that the rate of growth is driven from scarcity. But of course, us investors, we can't necessarily all go out and buy a $5 million property for a huge rate of growth. But should we actually analyze real estate with a similar context in mind? In other words, the better the real estate, the better the rate of growth versus some real estate, which really isn't scarce whatsoever, and a much lower rate of growth. So the concept of scarcity is something which I think is worth talking about. Scarcity is based on its location, the type of land supply coming to a neighborhood, the type of property type. Obviously, you know, there's only so many houses 20 kilometers from a city. Functionality, how good a layout is, the aesthetics of a property, the condition of a property, you know, a well-maintained home in a nice, quiet street is going to be more valuable than a much cheaper property in a noisier street, which is in, you know, less ideal condition. So scarcity versus regular properties is a conversation piece. And again, the more scarce something is, the more valuable it is, the higher the rate of growth you're going to get. And because of the higher rate of growth, you can typically just buy one good property versus two very average properties. So again, like if we think about the neighborhood character, is it a better neighborhood or is it a very basic neighborhood? Is the proximity to the right amenities, cafes, beaches, parks, performing schools, transports, that's going to provide scarcity versus something which is maybe just an area which requires a lot of driving. So when we think about locations, locations are a big driver of appeal, and as such, a big driver of just how scarce a resource is. And it's not to say outer suburbs cannot be scarce as well. They absolutely can. And today, because of urbanization, we end up in a place where the right outer suburb with the right scarcity factors creates the right level of growth as well. So when it comes to the two versions of really how wealth is created from real estate, the first version is scarcity. The second version is the general principle of money creation. And this is the idea of leverage and credit. Now, most people have become quite wealthy out of property of late, not because they own a scarce property, but because of credit expansion, basically money printing. Now, when you go to a bank to borrow money, they create money out of thin air. The money they are lending you has never existed before. And what that does, it creates more money in the economy, obviously creating credit expansion. And of course, that expansion creates an uplift of property values. It grows property. So where lending is happening, you often see a correlation of capital growth because most purchasers are buying a property based on how much they can borrow, not on its theoretical intrinsic value. And of course, that credit expansion, if you like, can obviously push values up and create inflation. And as more money is put into the economy, you get this kind of upward trend on asset prices. So a lot of inexpensive property is not growing in value based on its scarcity factor. It's growing in value because of credit. It's growing in value because banks create money in the form of loans. The money has never existed before, and that money is added to the M3 money supply here in Australia. It's basically new money circulating in the economy. And of course, when that credit expands through lower interest rates, like relaxed lending, increased banking liquidity, buyers can pay more for real estate. And of course, this becomes a challenge if you are buying a property which is less scarce, because really the only driver of it is debt. So debt is driving a less scarce resource. However, when it comes to better resources, there is also debt, but usually a level of cash and credit, which is shopping to secure those better assets in the marketplace. And this is where really we need to think about the median. The median is just really a static fact about the idea of credit expansion. It takes people up to a place where really at an average point, most people are shopping at. And today, the median for a middle tier property is now $1 million. So if you're buying a piece of real estate for $400,000, you are 60% below what the market is typically buying real estate at. And of course, that may mean you're buying a very good deal because it's 60% below the midpoint of the market. But equally, it may mean you're buying something that is not considered scarce. So the lower we go from the midpoint of the marketplace, typically we are leaving scarcity and going into credit expansion. The idea that really the growth will just come from borrowings and people taking on more debt. And so it's a balancing act because as an investor, we're theoretically taking on more debt. But what we would like to do as investors, where possible, is take that money expansion concept and use it to buy scarcity. Scarcity grows better than basically the idea of just credit expansion, the idea of basically more borrowings. Now, we've seen, I guess, the bad side of credit expansion in things like the GFC. Banks created more money, created more loan products, basically created more debt and lent people who could hardly afford it money, and created money out of thin air for those people. And it all kind of blew up because they were lending people money who basically didn't have a job. Now, here in Australia, fortunately, there is some pretty stringent credit policies to get money into the marketplace. But the most recent version of money supply coming into real estate will be driven off basically high LVR loans going into the first home buyer marketplace. First home buyers can borrow 5%. And I would imagine you will see entry-level properties go up in value through credit expansion over the next couple of years as a new wave of first home buyers come into the marketplace. So it's just the way the system works. And again, if we can borrow credit and use money expansion, the principle of money creation, to buy scarcity, that is the best use of that tool. Now, obviously, when it comes to any investment, you want a level of pie, population growth, infrastructure growth, and employment growth. If we buy real estate that's too inexpensive, we may be sacrificing a fundamental to protect us and our investment, which is pie, population growth, infrastructure growth, and employment growth. And typically, the more diverse an economy is, the better the pie. So if we were to make an assumption that all properties were created equal, then definitely it would be better to buy multiple properties than that of one. That is just logical. However, not all properties are created equal. It doesn't work that way. And again, the more scarce the resource in any form of economics, the higher the price. So one, for example, decent house would outperform, for example, 2 one-bedroom apartments. That's just the reality of how economics works. If you bought a house for $800,000 and 2 one-bedroom apartments at $400,000, the more scarce item is still the house at $800,000 as opposed to the 2 one-bedroom apartments at $400,000. Scarcity, it's a principle. Now, the one-bedroom apartments may rise in value, but that is going to be off the back of the general principle of money creation, not the general principle of scarcity. And again, this is why you end up with different types of capital growth affecting assets. And of course, the better the asset, typically, the better the growth. The biggest driver of long-term wealth is the driver of compound returns. One better property will achieve a higher rate of growth than 2 average properties. Why? Scarcity. So if you thought about the rate of growth is a percentage, the compound percentage of the asset. Now, if you took some pretty cheap properties and you actually looked into their rate of growth, some properties grow at 3% per annum. Why are they growing? Just because the money supply is increasing around it. Then alternative properties can grow at a 7% rate of growth. Now, a property at a 7% rate of growth is going to double in 10 years, whilst a property with a 3% rate of growth is going to double in 22 years. So 2 properties that are inexpensive with a low rate of growth will take a long time to compound on themselves, whereas one good property with a much higher rate of growth will perform faster. And so because it performs faster, your money is working harder and can be returned to you in a quicker format. Now, a lot of people look at the rate of growth and then the cash flow behind it. And this is where, again, you need to consider the idea of total return. Total return is the idea of growth plus effectively the yield. Now, the problem with the highest growing and the best types of property is typically they have a much lower yield. Even that property in Paddington I just described as the most scarce, the capital growth rate is so good, the yield doesn't keep up with it or hasn't kept up with it over that period of growth. So a $6 million property might rent for $2,000 a week, which is not going to help you hold the asset. The other big principle of real estate is the principle of time, the time horizon for your intrinsic value to appear in the real estate. Now, if you did calculations, you can see that a compounding 9% capital growth rate with a 1% yield will outperform a 9% yield with a 1% capital growth rate. The numbers after 20 years is huge. The difference is absolutely astronomical. The 9% growth rate with the 1% yield will, the property, if they were the same price, starting price, will end up in two different hemispheres 20 years later. If we were to track, for example, and I'll just pull up my spreadsheet, if we were to track a property for $500,000 on an interest rate of 5%, and we looked at the results after 20 years, that $500,000 property at 9% becomes a $1.9 million property. At 1% growth, that $500,000 property becomes a $510,000 property after 20 years. With a 3% growth, that $500,000 property becomes a $603,000 property. And the reason is capital growth compounds faster than yields. Now, obviously, there's a burn rate on real estate. And if you were to chase a 9% capital growth with a 1% yield, you're going to have to take a lot of money out of your back pocket. So, in fact, the most expensive properties in Australia are actually some of the hardest to invest in by virtue of we want the tenant to pay for our time in the marketplace, along with, where possible, tax deductions. So this is where we need to compromise. And again, if we can compromise with a 7% capital growth rate with a 3% yield, or a 6% capital growth rate with a 4% yield, or a 5% capital growth rate with a 5% yield, we're going to end up in a better place. Now, this is where, again, very inexpensive properties, if they are just driven off the principle of money creation, not the principle of scarcity, then they're typically going to have a capital growth rate of 1, 2, 3, or 4%. However, they may have a yield of 6 or 7% because they're cheaper to buy. And because they have not grown like other properties have grown in the past, the yield is actually growing faster than the rate of capital growth. Hence why you get a higher yield than the typical balance, which is a 5% return on a 5% capital growth rate. But if we were to look at, for example, a 6% capital growth rate with a 4% yield, which is, pretty typical of the right sort of capital growth rate you would be looking for without burning a lot of cash. After you take that real estate, which is your growth plus your internal investment, your total gains, you can see that your real estate is effectively, after interest costs, after 20 years, well, if you didn't include interest costs and you just went with total gain, your 5%, 6% property plus 4% yield after 20 years is worth $1 million. 1.5 million. Obviously, you deduct the interest and your net gain after paying interest is $1 million. However, if you take a 3% yield, a 3% capital growth rate is a 7% yield, which is typical of basically cheap properties, your net gain after 20 years is $600,000. So it's the power of these little 1% changes that you are $400,000 better off by buying one good property versus effectively two cheap ones. Now, again, in that example, you have two $500,000 properties, but let's change the calculator to now be $1 million. So we just bought one good property at $1 million, which is now the midpoint of the marketplace. What happens to our wealth? On a 6% growth rate and a 4% yield, well, our investment after 20 years effectively goes from $1 million all the way up to total gain of $3 million, less interest equals net profit $2 million. Now, if we were to go back to two $500,000 properties and we were just at a 3% return, again, or 3% growth rate and a 7% yield, we would have made $1.2 million. So it's a big difference. It's a big difference. And again, that's all driven by the general principle of scarcity. Now, again, if the properties can perform at the same rate of growth, it's better to buy two properties. But if the properties can't perform at the same rate of growth, then it's better to buy the one mathematical property which is going to do better over the long term. Now, obviously, you've just got to marry up the total return because that is the holding costs. And for some people, the math don't math because of their job, of their situation in life. And quite often for a lot of people, buying a better rate of growth, albeit the better thing to do, is just not feasible. And so there is a point where you have to sort of weigh up what you can actually achieve. Now, when I first got into real estate, I couldn't afford the best rates of growth. So I bought inferior assets to get into the marketplace. And that was just the way it was. But I didn't hold those assets. I sold those assets when they went up in value through the principle of money creation, more money coming into the market, driving growth. And when I sold them, I moved that money into better assets to hold the best assets for long-term wealth. Obviously, when you have more properties, there is more things to work on behind the scenes. 2 rates notices, 3 rates notices, 4 rates notices, insurance. So there is more admin work the more properties you have. That's just the way it is. In a perfect world, you would buy as many properties as you can that have the highest rate of growth. However, that's not always feasible. But when you're building wealth, don't underestimate that if you can buy something that is more scarce, it will perform better, whether it's an architecturally designed property, whether it's a house, whether it's the right apartment with the beautiful view line, it will perform better. There are benefits to cheaper properties. Typically, for example, you will get that better rent, and so that can feel like less pressure in the day-to-day, but you tend to suffer the future consequences of less capital growth. obviously, with tax implications around properties, quite often when you have two properties, there is an ability to get less land tax exposure, potentially spread out negative gearing benefits across a couple of properties. And of course, if you sell down a property, you're going to pay capital gains tax. So if you are selling one property, which is less expensive, you still have another property in your portfolio that is sitting there, which is kind of the nice thing about building a portfolio. And of course, diversification is another cool thing about having multiple properties. And of course, that means you can be in two marketplaces, which allows you two market exposures. You could have a property in Sydney and Melbourne, or Brisbane and Adelaide, or Perth and Canberra, and you're exposed to different activities in the marketplace. However, inexpensive properties are actually quite often the most illiquid. Now, remember, real estate is generally an illiquid asset class. But for a lot of real estate, if it's too cheap, it's very hard to sell, because surprisingly, most of society actually is driven by where is the scarcity, where is the lifestyle, where are the benefits to living, as opposed to investor logic, which is quite often just buying on price. And again, this is where if you get too far off the beaten track, just chasing price, you can enter a very illiquid marketplace, which means when you sell the real estate, you're going to have to discount it to inspire a buyer to come. Some marketplaces are so illiquid that it takes 6, 9, 12 months to sell a property. And they can be illiquid even inside of major urban areas. They are just not what that local demand is looking for. And so obviously, wealth modeling is an approach you have to consider. And when you model wealth, you've got to model cash flow, capital growth, and time. That's really all you're trying to do here. Now, again, if all properties were created equal, then you would simply buy as many as you can. But if the choice is a rate of growth which is inferior and having two properties versus a rate of growth which is superior and one property, you're financially going to be better off if you model looking at just one property into the future. Now, I teach modern portfolio theory, which is the idea that you want a blend of growth across your portfolio. Obviously, if you buy a good property, the return will eventually unfold and you will create equity, which if you can borrow back that equity, you should be able to buy more real estate. So I would recommend that if you can do it, think about one good one over two cheapies. And that's why you go on realestate.com still to today, and you can see very inexpensive properties on it. Now, I was just staying in Middle Park in Melbourne, and you can go online today and you will find inexpensive properties for $400,000 in that suburb, one-bedroom apartments. However, the four-bedroom house is $4 million. So the better the asset, the better the rate of growth. The house has grown, the one-bedroom apartment has stayed stagnant. And that is a good example of understanding scarcity. scarcity. That market doesn't associate that one bedroom as a scarce resource. Why? Because it's a family suburb of reasonably wealthy people who don't need the one bedroom apartment. And so when we think about real estate, we've got to think of how it forms inside of a society. A housing suburb will want houses. The right urban suburb close to the city, which is very walkable, which is full of 24-hour atmospheres, not a family place like Middle Park, would probably be better suited to that one-bedroom property. So we've got to think about it as a model of wealth, not the day of purchase. On the day of purchase, it feels like a good idea buying something less expensive. The better property strategy focuses on location and growth potential. Two average properties, they'll provide diversification, but at what complexity and costs? And if you make decisions on just cash flow, then you've got to assess the risk of your future investment horizon. It's really how this is broken down. But I hope that was helpful. Thanks, guys. I'm going to pause there and kick on with my day. Thanks for tuning in to the Urban Property Investor. If you enjoyed the episode, make sure to subscribe on your favorite podcast platform or YouTube so you never miss an episode. I'd love for you to rate the show and share it with your family and friends. Let's spread the word about property investing. Stay connected between episodes on Facebook, Instagram, and LinkedIn. And check out the rest of our podcast network at positivementor.com.au. And if you're serious about growing your property portfolio, don't miss our complimentary Property Investor Nights. Register now via the link in the show notes. See you next time.